Mickey Dickey here, and just want to give you a quick update on some of the baloney that I'm seeing going on in the marketplace and at least on the news on the marketplace. And the first one I want to talk about right now is inflation again. And the report I've got sitting up here says that inflation gauge tracked by the Federal Reserve falls to the lowest point in 2 years. And yet somehow this is a bad thing. And again, I'm having a difficult time with this because 1 and 1 always equals 2. I don't care who you say it from, whoever's talking about it, it's the truth. This makes no sense to me. Now, the reason I say that is that you've got these guys coming up here saying that the first quarter growth, gee, here's a shocker. The news says, or the government reported it was 1.3%, ended up being 2. So again, the economy's better, stronger, all this good stuff than we expected. So the economy's more resilient. Again, big shocker there. And again, this one's fantastic. I love listening to this guy, as most of you have seen, because again, what this dude says makes absolutely no sense. Now, let's listen to him for a second because I can hardly handle what this guy is trying to say.
The latest Delivering Alpha investor survey, which consists of the nation's leading institutional investors, top strategists, and our own CNBC contributors, we asked for thoughts on.
Now, I don't know anyone who thinks we should raise rates again. Now, 74% of these people, I'd love to talk to the people that are the 26% that think they should raise it again, but 74% don't think we should do anything. Is this not enough? Do we really need more than this? And again, we've got inflation coming down. We've got GDP doing better. We have employment going up. We have increases in wages. Everything we're wanting is going in the right direction. Why would you mess this up by raising more? It makes absolutely no sense. Now this idiot here, let's listen to him and we'll go back to the other one. Now, I want to make a point here. And again, most of you have been watching my videos and listening to me over the last 6-8 months. They were telling you not to get into large cap. Don't get in. It's uninvestable is what they called it back in November, December, and January. You couldn't be in it. You didn't want to be a part of it. Now, again, let me put this up here. My little spreadsheets that everybody my son gets on me about. And again, take a look at this. Year to date alone, the NASDAQ is up 31.7%. That's large cap, folks. And if you listen to the morons on television, you missed all of this. The S&P is up 15, the Dow is up 3. Now, does this mean that the market's gone berserk and out of whack? I don't. We've been in a bull market for a long time. But up from the bottom, look at this. The NASDAQ's up 37, almost 37%. 27 on the S&P, 20 on, almost 20 on the Dow. Now, we're not quite back to the peaks. We're still down 14% here. So we've got room to go. Even though we're up 30, almost 32% in the NASDAQ, we've still got 14% to get back just to where we started almost 2 years ago. But then you got these idiots on here saying this stuff.
Bianco, DWS Group America's CIO. David, great to have you with us.
Good morning.
What do you think? Where do you fall in that survey?
I'm still cautious. I've been cautious all year, but it does look like it's been a great start of the year. Looks like the equity market's trying to start the fireworks early. It's been a great half. You might get to year highs for the year. I think that will depend on the inflation report at 8:30. But the market's doing well. I would argue that the challenges are still ahead. The Fed has not landed this plane. It needs to point the nose down more because one of the things that's happening here is this wealth effect from the equity market is keeping spending power strong. And the equity market's going to make the Fed's job a lot more challenging.
The equity market and also the housing market.
Yeah.
Okay, so help me understand this, because again, I'm really having a hard time grasping the concept here. The equity market still down 16, almost 16% in the NASDAQ. You're still down in the Dow and the S&P. Where is this wealth effect and on the economy or the market affecting Powell in any way, shape, or form? Which again, there are two separate things. I keep saying this and I'm going to keep beating it until somebody actually understands it. It is completely different. The people buying and selling on the stock market are not the same people that are out getting jobs, working at Home Depot, working at Arby's, and that kind of, it's a different world. Okay, and they don't necessarily overlap all the time. They do from time to time, but for the most part, they're really not. And the real estate market. We've talked about this in my other videos, and we'll talk about it more when we get the new numbers out. but you're actually down year over year. And more importantly, in the CPI and the inflation numbers, you're still up 8% year over year because of the lag effect in shelter. And that's going to help with the stickiness of inflation going down the road. Am I the only one that sees this? I can't imagine that I am. Anyway.
Prices remain fairly resilient here, and so you got to wonder. I mean, if Jerome Powell was looking for a reset in the housing market, he's not getting it there, and he's not getting any help from the equity markets either.
The data does not suggest that they're done hiking, and the data would suggest that there's more than one hike probably to go.
What data? Again, the markets are still down, real estate's down. What data are these idiots looking at that suggests that we should be raising rates or even have raised them to the point that we're at now? Please show it to me, because I sure as heck don't see it. They keep talking about it, but they never show it to you. Seriously, people.
We know, right?
We know there's at least one. I think
at
that's
least two. I mean, most are in favor of at least two.
And I'm beginning, and some of the investors I speak to are beginning to seriously consider three, and that there's hiking going on for the rest of the year.
What are we talking about? Again, if we're at 3.1 in June and 2.7 in July, or maybe lower, what on earth are we raising rates for? Again, rather than just spouting stupidity on here, can we actually give some numbers and statistics to back up whatever in the earth you think you're talking about or that you know about? Because here's the part of it that really gets me.
I'm still cautious. I've been cautious all year, but it does look like it's been a great start of but the market's doing well. Spending power strong, and the equity market's going to make the Fed's job a lot more challenging.
The equity market and also the housing market.
Yeah.
Prices remain fairly resilient here, and so you got to
Sorry,
wonder.
I backed up
if
the
Jerome
video.
Powell was looking for a reset in the housing market, he's not getting it there, and he's not getting any help from the equity markets either.
The data does not suggest that they're done hiking, and the data would suggest that there's more than one hike probably to go.
Which we know, right?
We know there's at least one. I think
at
that's
least two. I mean, most are in favor of at least two.
And I'm beginning, and some of the investors I speak to are beginning to seriously consider three, and that there's hiking going on for the rest of the year. Why? As you said, housing, which is supposed to be very sensitive to interest rates, new housing starts at least are still very strong. Labor market's rock solid. Economy is buoyant, not growing robustly, but not recession, not yet. And now you've got this equity market. Let me make this point. It's not a valuation point. It's a wealth effect point. The U.S. equity market is 160% of U.S. GDP. 40 plus years ago, the last time we had this kind of inflation problem, it was not even 40% of U.S. GDP. So the wealth effect out of equities.
Again, this is not the wealth effect. This is what I've been saying all along. The reason why the stock market and the economy are two different things is what he just said. It's 160% of GDP. The people that are investing in the stock market are not going to let themselves lose money month after forever, okay? They're going to turn it around. They're going to make it so that they make money. Now, at some point, they're going to get to the peak, and they're going to go what normal people would do, and that's take money off the table and take profit off the table, so it'll go back down again. But again, they're not going to just sit back here and just let it go because they've got too much in it. If you've got 160% of GDP, you're not going to let this happen.
This is 4 times as much as it was back then. The Fed has to keep an eye on this equity market as part of its navigation.
Why? What does this have to do with anything? The wealth effect has nothing to do with inflation. And I know you're going to bring it back around and try to say that that's where inflation is coming from. It is not where it's coming from. Inflation is what people are willing to pay. Just because you have $1 million doesn't mean you're a moron and you're going to pay too much for things. In fact, most people that actually have money don't overpay for squat because they don't have to. Where you actually run into the people that have the problem with inflation is that they have to overpay for things that are just normal things. So the people that aren't on the higher end of the scale end up getting hurt on it again because they end up again, spending too much for an apples, too much for a loaf of bread because they don't have a choice but to buy those things. The wealth effect that he's trying to make a point here that the people that are wealthy, they're going to buy the boats. It's like, again, what's driving this economy and what's driving inflation and has driven inflation, which again, has nothing to do with what the Fed's doing, again, personally. But it's not about people buying boats and jet skis at the higher end of the scale.
We have a decent roadmap of where the Fed is going to go and the sort of the side effects that at least two hikes will have and higher for longer will have. And yet we are still at these valuations. One could argue if you are a bull that we've taken all of that into account and that we are still at these levels?
Yeah, and markets are smart, but the S&P.
Okay, so yes, the markets are smart. The people that are buying and selling in the markets are smart. And yes, they have taken all this into consideration. And yes, they took the negative parts of all of this stuff and they sold the market down way, way low. Again, that's why the NASDAQ was down 38% from its peak. Again, this is not new.
S&P's 20 times this year's earnings. I don't see a whole lot of upside to the about $220 of earnings I'm estimating for this year. Tech sector's 30 times earnings. Certain big companies in the tech sector that traded for 15 times earnings over the past 15, 20 years while delivering terrific growth, they're at valuations that are 30 times that.
Which again, maybe it's not about valuation. And again, we've talked about this multiple times. It doesn't matter what Apple's market cap is. When you have billions of dollars on a daily basis going into mutual funds and index funds that own Apple on a daily basis because people are putting it in for their 401ks and their retirement plans and their IRAs, it's just going to work that way. Now, to go back to
whether the Fed should hike rates, 74% of the participants said they should pause. The rest think they should hike. Nobody thinks it's time to cut rates. For his thoughts on this and the markets, let's bring in Mohammed El-Arian, Chief Economic Advisor at Allianz and President at Queen's College at Cambridge University. Mohammed, great to see you. Where did you fall in that survey?
So I think if they are serious about that 2% inflation target, then they should hike.
Okay. Those of you who see my other videos, I have repeatedly and continuously beat up this dude. And I don't know who's paying him to do what or wherever or where he's got his degrees or anything from, but everything this man says is completely wrong. He's been saying that one day he says that we've got too much on inflation or too much on interest rates and that we're going in the wrong direction and we're behind and we're this, that. Nothing's been right. Why do we keep putting people like this on the television? Because it might provide a narrative, but why don't we get some content on television that actually is helpful for people? Because this isn't. Again, when interest rates are continuing to go down for 11 months in a row, which there's going to be 12 months in another couple of weeks, from 9.1 to 3.1%, and you're telling me we need to raise rates again, even though we always can say that there's a lag effect of 12 to 18 or 12 months or 18 months on interest rates. This makes absolutely no sense. I don't know why we even listen to this idiot. And again, I can't even go on anymore with this. It just makes no darn sense. Now they're calling it a timid bull market. Really? It's up 30 some odd percent. And what's interesting, now there's a person on here, and I'm not going to run through the whole video, but if you get a chance, watch this video because, actually, let me put him on here because he does have some really good points. Of the people we're listening to today, this guy actually seems to have somewhat of a brain. Now, I haven't listened to a bunch of his stuff, but what he's saying, at least today, makes perfect sense.
And we're entering a new bull market.
And I like this gal because she does a pretty good interviewing job.
Director of Global Macro at Fidelity Investments. It's great to see you, Urian. And in light of the weakening sort of macro backdrop, if we want to call it that we were just discussing, what are your observations about the market tell us?
The market has gotten impatient, right? We've all been waiting for that other shoe to drop, whether it was the recession or the down in liquidity as the Treasury replenishes its cash balance at the Fed. And
now, what he's saying here, and you've heard me say this, and this is why I like what he's trying to get to here. Now, this is a week-old video, so please understand that the market's changed a little bit since then, not a lot. But what he's saying is that in the news, and for the last almost 2 years now, we've just heard negative. The economy's falling apart, that the stock market's falling apart, all these negative things are coming into to be. And the market took all that into consideration looking at what was going on. And that's, again, why the NASDAQ went down 38%. But none of it's happened, which, again, I look at what they all said about Powell, and while Powell was behind the eight ball and all this kind of good stuff. Again, I don't think he needed to do anything. But here we are. They're getting tired of it. And the reason they're tired of it is what I keep telling you. Just like the other gentleman, it's 160% of GDP. The people that have money in the market are not going to sit around and wait forever and a day. They're going to make their own market. They're going to make it work. So it's not about bull and bear anymore. Those terms probably need to go away going down the road. And if you want to call them shorts, but what used to take 2, 3, 4 years is taking months now. Because again, look how quickly we go through all this stuff. We don't deal with things on I mean, if things last more than 2 minutes, it's an eternity.
Market's now been in a state of limbo, if you will, for about 18 months, right? The peak was early January of 2022. And that, of course, followed a mini bubble during 2021 when the Fed pushed rates way, way down and kept them there for a long time. That did create an asset bubble. It did elevate the markets above its trend channel. And so it's good that we fell back into it. But 18 months is a long time. 10 months of declining and then another 8 months of just sitting around doing nothing. And the market has been in a trading range now for a year, right? June of last year was that momentum low, and then October was the final low. And so I think the market's just getting impatient. You see the earnings estimates are actually starting to improve. The revisions are starting to get better now. And 2024, the estimates could be all wrong, of course, but
So what he's trying to say is exactly what I've been saying. We've already gone through this. This was already planned ahead. All the revisions from all the companies are going up. All the revisions for everything for the economists are going up. And again, they might be wrong. I'm not saying they are. But a year ago it was all negative, and we've gotten past that. And it's not like we're 20% above the all-time highs. We're still down. But this guy's got it right.
But the consensus estimate is now for about an 11% gain in 20. And the Fed, of course, is not done yet. We certainly got the message loud and clear in the last couple of days. But with the Fed at 5.25, presumably going to 5.5 or even 5.75, and if we think about the neutral rate being somewhere around 3.5, the Fed is reasonably above neutral or reasonably restrictive. That I do think we're getting closer to the end of the cycle than the beginning.
Now, I am getting very tired of this closer to the end than we've been closer to the end for almost a year now. This is just stupid. We're beyond the end. Like I said, at some point they're going to change the narrative here and it's going to go back the other direction. But I do like what this guy's saying. Finish the rest of that video, which again, I like what's going on there. What I want to finish the day with here is just what I've talked about before. We don't need to do anything else. Everything's going in the right direction. If you're on an interstate, you're driving 70 miles an hour, and that's what the limit is, maximum speed limit is. Why do you need to change? If you're going to get to your target on time, you don't need to speed up, you don't need to slow down, you don't need to do anything. That's what's happening right now with the economy. The Fed needs to do nothing. Again, I think they've gone too far, but bottom line is just stop. And let's get more people on like the other gentleman that actually gives some information on here. This is what we need to be looking at. We continue to look at it. As we continue to see, these things are coming together, and at some point, these are going to converge when they're all at the zero, and we're going to be back to the beginning, and then we're going to start talking about, is this going to continue or not? That's my 2 cents worth. Dickie out.